The following program paid for by Lifespan Wealth Management. Providing financial advice since 1993. It's time for Your Money with Sherry Goss, Randy Goss, and Jonathan Eisner. And now from the Macon studios of News Talk 940 WMAC, it's Your Money.
Good morning, Middle Georgia, and thanks for tuning in to Your Money, produced by Lifespan Wealth Management. As financial advisors, the main thing we do is provide retirement planning advice and manage our clients' investment accounts. So if you're looking for an investment advisor, call our office at 478-922-8100 to set up your complimentary consultation.
Lifespan Wealth Management has offices in Macon and Warner Robins for your convenience and has been serving Middle Georgia for over 30 years. You can learn more about our services by visiting our website at retirerelax.com. And while you're on our site, go to the special reports section where you'll find several reports that are available to you for free. You can also sign up to receive our digital feeds, which are short videos providing great information relevant to retirement, investing, and matters that affect your money.
We also offer seminars to the community at no cost. So if you're in need of a guest speaker for your church or civic organization, give us a call and together we can decide what topics you would like us to present to your group. Again, our contact number is 478-922-8100.
Good morning, everyone. It's great to be back with you this morning. I've been meeting with clients all week and explaining what is going on in the world. Sorry, I'm raspy. It's this weather driving me crazy. Some are stressed out because of what they're hearing in the news, and most are fine with the deals Trump is working on making. Just a reminder, you can go to our website, retirerelax.com, and click on other resources and useful links where you can read the Wall Street Journal for free. It is a great resource that can give you the facts without the spin. Just ignore the opinion section, please. Now, on to the show.
All right, and we're going to talk about some of those issues right now. And we're really going to kick off the show talking about that 800-pound gorilla that's in the room, which is the stock market right now. The stock market has been on a roller coaster ride lately, up one day and then down the next, and the swings have been significant. The volatility is a direct result of the uncertainty in the political environment, reflecting concerns over tariffs imposed by the Trump administration and the retaliatory measures from the other countries. Essentially, the market is gauging the extent of the economic inefficiencies that may result. Please understand that this comment is not meant to be political in any way. It is just a fact. The stock market does not like uncertainty, and when there is uncertainty, this is how it reacts. You can expect to see increased volatility leading to sudden price swings, and these price swings can be in individual sectors or across multi-sectors as we see now. And you'll also see lots of people selling to flee to the safety of cash or low-risk assets like bonds.
But historically, the uncertainty generated by tariffs is generally short-lived until the details are worked out and trading partners come to terms. And then the markets will have clarity on how the various impacted industries will react to these tariffs and how it will affect the company's profitability and their growth prospects. Yes, tariffs can be justified for national security or to protect specific industries and communities, but they do come at a cost. And of course, businesses have options. They can either pass the cost to consumers or absorb the cost. Either way, the financial markets will adjust to expectations of weaker earnings growth, renewed inflation, or a combination of these factors. The risk to economic growth and not inflation seems to be the bigger risk to the economy based on the falling 10-year U.S. Treasury rates, which have fallen to 4.2% from 4.9% from mid-January to the beginning of March, according to Bloomberg. I listened to 2 webinars this week from asset management companies that we follow, and one was very positive about where we are headed with Trump's leadership, and the other was mostly concerned about the amount of debt our country is in, which Trump is focused on correcting.
Yep. And the Trump administration expects a formalized tariff plan in April. Excuse me. We can all hope that calms nerves a little bit. The next steps from the admin will certainly compound the issues if the administration does not deliver on that plan for April. But what we can expect even now is that businesses will alter their spending in preparation for increased cost due to the tariffs. A few weeks ago, we briefly discussed the 2018 trade war with China, which led to about a 20% decline in the markets, which in turn slowed consumer and business spending and confidence. In turn, this forced the Fed to lower rates. Today's events could follow the same path. A March 7th article in Reuters noted that Trump's trade actions in his first term were far from being inflationary, but caused global growth to slow and led the Fed to cut rates.
Yeah, and let's take a look at market return for a minute to hopefully calm your nerves a little. And if you're looking at the markets year to date, say January to today, for the S&P 500 is down 5.2%, 5.26%, as the, and the heavy, excuse me, the tech heavy Nasdaq is down 9.71%, and the Dow is down just 2.61. Despite these negative numbers, the year over year, that's March 2024 until March 2025, the numbers still look pretty good. The S&P is still up 8.87, the Nasdaq is positive 8.84, and the Dow is still up 6.87. Now, while it's important to keep your eyes on the investments, it is important to understand how the macro environment that surrounds them takes place. In this case, many leading economists call for calm and not to be reactive. A lot of trading you have seen in the market are people rushing to cash who don't have a plan on how to get back in. It is extremely difficult to understand where the bottom is and when to get back in the market. Ultimately, missing some of the best trading days is extremely possible. Anyway, we hope this provided some perspective on the whole situation and all. We all want this situation to level out. That's the bottom line. We believe this is the best for our country in the long run, even if there is a little pain up front.
So we typically stop out of holdings when they're down a certain percent, but this time that could be a huge mistake, so we are not. This is a temporary situation, and we went through this the last time Trump was elected.
Yeah, and I think it's important too. We talk about perspective. The three of us, talked a lot about perspective this week, but you got to remember that all three of the indices, the Nasdaq, the S&P, and the Dow, were all three at all-time highs a month ago. All-time highs, and
That's
you
right.
can't sit at all-time highs forever. So there's always some correction involved. Like Sherry's saying, we feel like this is a short-term meaning 3 to 6 months, hopefully, before we see this thing turn back to the upside. But here's a little bit more context for if we're talking bigger picture perspective. These are the returns. I looked this up. These are the actual returns in the S&P 500 in the last 5 years. This is 2020 through 2024. 2020, up 16.3%. 2021, up 26.9%. 22, we all know 22 was a rough year, down 19.4%. 23 up 24.2, 23 was up 24%, and 24 was up 23%. Wow, that's confusing. 23 up 24, 24 up 23. All right, and then 25 down so far 5.3. So if on January 1st, 2020, you had put $100,000 in, I love running exercises like this. If you had some way to put it directly in the S&P 500, which we don't, but just hypothetically, that $100,000 put into the S&P on January 1 of 2020 would have been at the end of 24 with those returns would have been $182,000 in those 5 years. So going off the same example, if you still had that money invested, thus far in 2025, you'd be at 172. And that's through the first 2.5 months of this year. So granted, I mean, that is only 2.5 months. It could continue to decline further. But here's the problem. This is what Sherry's saying when she says we are choosing to not stop out too early on our holdings. Here's the problem is that when you sell while you're down, you've locked that in.
That's right.
You've locked it in, and there is a significantly lower chance that you're going to recover what you just lost if you don't stay the course. Here's an example. In those numbers I just put out there, 2022, which was down 19%, your account value in this $100,000 example went from $147,000 at the end of 21 down to about $19,000 at the end of 22. Okay, let's say you sell at the end of 22. Well, you're locked in at 119 until you decide to get back in. Well, the account value at the end of 2023, which was up 24%, if you had just stayed the course, was right back at 147,000. Right? So stay the course, full recovery within 12 months because you stayed into the investments that give you the best chance to lock back in on the upside and gain your what you lost.
Let me
Yes.
throw in a note here.
Yes.
So we have clients who are retired. They're on a fixed income, and they cannot afford to be bumping around like this because they're taking distributions that they live on. And so people that are in a conservative model are in way less. They're not 100% in the market at all. Right now, they're only 50% in the market. And so I met with two people yesterday that are very in our conservative model because of their age, and because of their cash flow and what they need to not lose. And they're hardly down at all. And so they were relieved to see that they're okay,
Mhm.
their money's still coming out, they haven't lost a bunch. And so it all depends on where you are in this cycle of
Sure.
life and financial world.
And this is where it really does pay off to have a financial advisor that you have a relationship with, that you can pick up the phone and call them and talk to them. Because if you're watching any of the
News.
news, the slants that they put out there is usually not good, because what bleeds leads.
Oh, I had a person call me yesterday just absolutely freaking out about the market and the economy, and he thought he was going to lose all of his money and everything bad, and I had to right size him.
Yeah. Well, the other thing we have to point out here is that, the past performance is not indicative of future performance. So, the numbers that we give you are for illustration purposes only. That should satisfy compliance purposes.
There you go.
But, also back in 2022, we know that was a rough year. And in that same year, CNBC polled investors who had pulled their money out of the stock market and found that 40% regretted that decision. So that's pretty telling.
It is.
It is.
And I, of course, the example I was giving is not a blanket for all
Right.
That's
people.
right.
And I'm
It's
glad
not.
you said what you said, Sherry, because it's not applicable for everybody. But if you're on the alternative is if you're on a fixed income and you don't need necessarily tomorrow or next month the money that's in your retirement accounts, try to leave it. Try to leave it and let it
That's-
recover.
Because historically, the stock market recovers in a fairly rapid amount of time.
Right.
So
Right.
just take a breath and talk to your advisor. All right. I wanted to talk about an IRS notification. You might get, if you're a business owner, you might receive this. And when you receive a letter from the IRS, your pulse quickens and you really don't want to open the letter.
I get them every year. I
Yeah.
get two,
And you
and they make me sweat.
Yeah, and it's it's not like a Christmas or birthday present that you want to rip open and see what nice surprise awaits you inside. A letter from the IRS feels like something lurking, waiting to jump out at you, like Freddy Krueger or the spider at the beginning of the Arachnophobia movie. Well, this past week I received such a letter, and I ran through those exact feelings. And when I finally got around to opening the letter, I was stunned to see that the IRS had audited my September 30th, 2020 Form 941, which is the employer's quarterly federal tax return. And to my surprise, I found that I had overpaid my taxes, according to them, by $17,342.66. Needless to say, I was shocked. And then I was a little ticked off because I'd paid a CPA to complete my taxes. So I sent the CPA a nice message and asked them to explain how this was even possible. And before I sent the message, I'd already figured out this had to be a complete error on the IRS's part, because there's no way. That's about what I would have owed. And there's no way that I owed nothing. So anyway, turns out the IRS, during this time frame, everyone was working from home, and now everyone's being pulled back in the office. They're making huge errors and sending out all these checks. I mean, we're talking about tens of thousands of these letters are being sent out to business owners. And the IRS letter says that will receive a check in the mail in the next few days for this amount, right? So I'm telling you this because if you receive one of these letters, you need to contact the person who completed your tax returns and have them contact the IRS. The letter you receive has an 800 number to call, and more than likely you are not entitled to this check. And if you cash it, the IRS will be coming after you for the full amount.
How wonderful.
Yes. Also, retain any documents in conjunction with this to include the notes from your phone call. So, because if you completed your taxes yourself, you're going to have to be the one completing this information, be it a call or a letter. And this letter says that I had $2,841 of interest on this money that I am required to file on this year's taxes. And I'm certain the IRS has notes on this interest income, even though I am not entitled to any of this money. So to protect myself, I'm making sure I keep track of everything, because I'm sure I'm going to be audited this year just because, on my personal tax side, just because of this doggone interest.
So I've been audited twice as a business owner here, and I will tell you that it's not fun. And so you need to make sure that all of your income, expenses, and everything you're doing is clear and easy to explain. When they call you, they want to see everything. And they
Yep.
spent 4 hours with me, grilling me, asking for documents, looking at payroll, looking at my checkbook, looking at every check I wrote. I mean, trying to find something that I had done wrong.
Yeah, they presume
was-
you are guilty until you prove
Yes.
that you're innocent.
And they have a badge. They wear a badge.
Yep.
I mean, they
And a gun.
Yes, it is not fun. So if you own a business,
Anyway,
please make sure you're
Yep.
doing everything right, because you don't want to deal with that.
Yep. If you and do not delay calling the IRS if you get this letter. You need to get on record that you don't want this check. Okay.
I got to make one more comment about the audit.
Sure.
So I have a client. She's very successful. She got audited by the IRS. They had a team of, I think it was 7 people, digging through all of her records of all the sales and profits that she'd made from real estate. And she called me and she said, Sherry, this is the most stressful thing I've ever been through. They're digging through every checkbook, every account, looking for something I've done wrong. I said, well, that's what they do. What they found, she gave Christmas presents to her top producers without recognizing that is a gift. And that's where they got her. They got her because she didn't expense it properly in her checking account, that she bought these bracelets for her top producers. I think there were 3 of them. And that's where they got her.
Wow.
And that's what led them to be there. They were in her office for 10 days after they found that, looking for more stuff that she'd done wrong. It is not fun at all. So anyways, make sure that you're doing everything right.
As if it's not intimidating enough for them to be there in the first place, the gun on the hip is the real icing on the cake. It's like,
The
you
badge
do one
was
wrong
enough
thing.
for me.
Right. Jeez.
Anyways, on to the next subject. A number of exchange-traded funds are popping up that aim either to invest politically or to find opportunities amid deregulation. Be careful. Already, so early in the second Trump administration, several products are seeking regulatory approval, and observers say more will almost certainly follow. Such ETFs, such as a MAGA 7 fund, clearly a play on the Magnificent Seven, but with the twist that the fund would hold stocks poised to do well under Trump. Another focuses on deregulation, and one even hopes to invest similarly to Trump's proposed sovereign wealth fund. And that's to say nothing of a line of funds from Trump Media and Technology Group subsidiary Truth.fi, which has filed trademarks for 3 ETFs and corresponding separately managed account strategies.
Yeah, in the vast world of ETFs or exchange traded funds, it's not much of a stretch to say that there's a product for just about anything out there. But there is a question of whether the wave of proposed ETFs is just riding a meme or offers genuine opportunities. One example is Point Bridge Capital's America First ETF with the ticker, you guessed it, MAGA, which launched in 2017 and currently has less than $31 million in total assets under management.
That's not much.
I'll explain more on that in just a second. That ETF, according to the company, is the first ETF of its kind, providing investors with the opportunity to make investment decisions based on their Republican political beliefs. It tracks an index of 150 of the S&P top 500 companies whose employees and political action committees are highly supportive of Republican candidates. Another existing product, the God Bless America ETF, this is hilarious, with the kicker YALL, YALL, says it caters to, quote, God-fearing, flag-waving conservatives. A lot of people around here would like the YALL ticker, I think. So it launched in 2022, and the managers exclude the stocks of any company that has, quote, emphasized politically left and or liberal political activism and social agendas at the expense of maximizing shareholder returns.
Wow. But
Yeah.
perhaps the best-known firm in the broader category of so-called anti-woke investing is Strive Asset Management. That firm, which is co-founded by former presidential hopeful Vivek Ramaswamy, counts 13 ETFs in its product line with a total of about $2 billion in assets. Another actively managed ETF would invest in just 7 stocks, and its prospectus reads, to provide targeted exposure to companies that appear positioned to benefit from the economic, regulatory, and political environment shaped by the Trump administration and its potential future impact. Wow. Clearly, ETF issuers see a market for political investing in various forms. Cash Ahmed, president of American Passive Wealth, says that there is a temptation to invest in line with political beliefs, fads, or means, but he says, stay away.
There is an ocean of ETFs on the market, as issuers can create obscure indexes and curate their holdings to follow them, and such themes are often a distraction for serious investors. Your money is too important, especially if you don't have enough, to be throwing it at something that is shiny. Investing should just be investing. You shouldn't try to mix your politics or emotions with what you invest in.
I completely agree with you with what you guys are
Yep.
saying, and this falls into the broader category. We've talked about this of emotional investing, which
Yes, absolutely.
usually doesn't end well. So, but another concern, and I looked those two tickers up, y'all and MAGA. Another concern with these types of ETFs is what we call liquidity. The more obscure the category that they brand themselves into, and those are some pretty niche categories we just talked about, the less trading they usually do in the market. And I looked up y'all's average daily trading volume, 14,000 shares a day. In the American stock market, that's pretty much non-existent.
Yeah, and just to be clear, when you say liquidity, if you're trying to sell something, that just means you might have a hard time getting out of it.
At least at a minimum, you're going to have a hard time getting the price you want to get for it.
Yeah, or
Bec-
when I say getting out, I'm saying getting out in a timely manner.
Right, that's
Yep.
true. Now, y'all is only $36 per share. So for it to be a $36 holding and only trade 14,000 times a day on average, it's pretty risky. Here's some perspective on that, though. Vanguard, now I'm going the opposite extreme, granted, but Vanguard's trademark S&P ETF, VOO, VOO, trades over 6.6 million shares a day on average, and it's valued currently, as of the day I did this research, at about $514. So a much more expensive holding traded over 6 million times a day.
Yep.
That's one you're not going to have a problem getting out of when you're ready to get out of it.
That's right. And
Right.
generally, you want the companies you buy and trade in high volumes. High volume trading means that there is a competitive market for your stocks, and you can buy or sell it with ease.
Yep. All right. BlackRock's CEO, Larry Fink, is worried about the future of the U.S. economy, especially when it comes to inflation and mass deportation of workers. So much so that he took his concerns all the way to the White House. He told members of the Trump team that we're going to run out of electricians, that we need to build out all these AI data centers. We talk about these a lot too. He says that we just don't have enough people. While an AI-first future may seem inevitable thanks to the popularity of generative technologies like ChatGPT, it will only succeed with an expansion of data centers. And electricians are one of the most critical professions in the construction pipeline. The U.S. Department of Energy estimates that data centers could consume up to 12% of total U.S. electricity by 2028, up from about 4.4% in 2023.
Right. Demand for electricians is expected to grow by 11% over the next decade, according to the U.S. Bureau of Labor Statistics. And with immigrants making up over 100,000 electrical roles in the U.S. alone, alongside hundreds of thousands of union electricians reaching retirement age, the profession is being faced with a perfect storm that could have far-reaching effects. But all might not be lost thanks to some younger Americans catching on. Gen Z grew up watching the tech industry in awe, and many aspire to one day work at top companies, whether it's Apple, Google, or Microsoft. However, gradually the generation has been pushed away thanks to layoffs, hiring freezes, and a cultural shift in Silicon Valley.
Students are warming up to the fact that the skilled trade industry may be worth it instead, with one survey finding that 55% of Gen Zers are considering a skilled trade career path. Moreover, enrollment at vocational focused community colleges increased 16% in 2023, the highest level since 2018. The field can bring many perks, including the potential to make a high-paying salary, sometimes more money than a four-year college degree graduate. Plus, a role can avoid the debilitating pain of thousands of dollars in college debt or the fear of being replaced by AI. Social media, too, is driving students to professions like construction workers, electricians, and plumbers. 2 union electrical apprentices described their profession in a video. You get paid to go to school, you get paid when you're at school, and when you graduate, you make $109,000 a year. Go figure.
That's right.
Pretty good plan.
Yep. Several years ago, Governor Deal put the high demand workforce initiative in place, and it's still going strong today. If you or someone you know is looking for a career change, you should check it out. Check out the list on the high demand careers opportunities through the Technical College System of Georgia, or TCSG. You can go to tcsg.edu. It's an excellent website that provides a complete listing of high demand careers and information that can help you get started. Last year, over 27,000 students graduated from technical colleges around Georgia, and 98% of those graduates are presently employed or even continuing their education. So if you're one of those people who just can't seem to get ahead financially, then maybe you need to check out a new career path that pays more money. I know this article was about electricians, and I know that electricians can make a lot of money, but there are other career fields that pay equally well, if not better, and a lot of schools can be completed in months, not years. Oh, and there are 18 programs of study which are free of tuition, so you might want to check these out. Check out the website to see if you're interested in any of the free options. And again, that website is tcsg.edu, and good luck.
You've been listening to Your Money, produced by Lifespan Wealth Management with your hosts, Sherry Goss, Randy Goss, and me, Jonathan Eisner. If you'd like to contribute to the show, you can email Randy at rfmoney.com with a question or topic that you'd like us to cover in a future broadcast. Our number is 478-922-8100. We have offices in Macon and Warner Robins for your convenience.
And you can find out more about us by visiting our website, retirerelax.com. Lifespan Wealth Management has been serving the Middle Georgia area for over 30 years, helping people like you achieve their investment and retirement goals. And if you're in need of a financial advisor, please contact our office at 478-922-8100.
We also offer seminars to the community at no cost. So if you are in need of a guest speaker for your church or civic organization, give us a call and together we can decide what topics you would like us to present to your group.
Again, our contact number is 478-922-8100. Now back to the show.
Did you know that there are approximately 29 million forgotten retirement accounts in the U.S.? They hold nearly $1.65 trillion in assets.
And every time I hear about this, I'm always amazed at how many accounts have been abandoned, basically.
I've seen a lot of
I was going to
this.
say the exact same thing. So we report on this a decent bit. We
Yes.
see these reports from Vanguard and whatnot, and all these old retirement accounts that people just completely abandon or forget about. It's shocking to me.
Yep.
Sadly, the situation is more common than you think. According to the Bureau of Labor Statistics, baby boomers born between 1957 and 1964 held an average of 12.4 jobs. That is insane. Before the age of 54. And the first 401k program was implemented in 1981. By the year 2000, more than 3/4 of American workers were participating in a 401k. With multiple jobs comes multiple retirement accounts, making it easier for some to get lost in the mix. If accounts are left unattended for a period of time, they can be transferred to the state as unclaimed property. That
So
would be
here's-
very disappointing.
Here's the problem that I see. So back in the day, when I had my first job, we had a seminar after I was eligible for the retirement plan, 401k at the company. We had a seminar, and the guy that was our advisor over the 401k would come and teach us about the program and the benefit of contributing and the fact that it was pre-tax and what the mutual funds were, which one. And he would sit down with each of us and go over all of that and talk to us about, do we have anything anywhere else? This got dropped because of COVID. Nobody goes into a company anymore and does a seminar.
Right.
I don't see anyone who gets any education.
Everyone assumes it's online. Go educate yourself.
Well, it's horrible because people around, I see people because they're retiring from the military in 2026, they pick the 2026 fund, even though they're only going to be 40.
Right.
I mean, I see so many mistakes all the time, but that is the problem. There's no education in the workforce to help people understand they need to take care of this stuff.
Yep.
And I don't see any fix to it. I don't hear anything about anybody doing anything better to prevent this junk from happening. But
Right.
sorry, just had to throw my 2
No,
cents
that's
in there.
fine. Well, here are some steps that might help you locate your missing accounts. First, start with your previous employers. Contact your former employer's human resource department and the financial institution that may manage your accounts. They might be able to help you access the information on them. Next, use online resources. Several databases can help you locate missing accounts. Databases such as the following: the National Registry of Unclaimed Retirement Benefits. Next is the Department of Abandoned Plan databases. There's Free ERISA. And then there's the U.S. Pension Guarantee Corp database and the missingmoney.com. And I was on missingmoney.com yesterday, as a matter of fact, just sifting through it to see if any of my relatives are on there. And my father, who passed away over a decade ago, he is still on there.
What?
Yep. So we're going to have to look into that one.
I thought you were about to say that you were on there seeing if you had any old.
Well-
After we were just saying, I can't believe all these old accounts are out here, and then you were on there looking for one of your old accounts.
Well, I know I'm not on there. You know,
Right.
I've only had 2 jobs in my life.
Oh,
So
that's easy to keep up with.
it is very easy.
Right. So you can also check state resources. Your state's unclaimed property database might help locate funds that were turned over to the state agencies. Go to the Retirement Savings Lost and Found database, which is lostandfound.dol.org. This database serves as a centralized location to find lost or forgotten benefits and get information on how to obtain those funds. It is a great resource to help you learn about tools and resources available to you to help you cover your hard-earned benefits. Here's another, I'll just side note, here's a problem too. What if you went to cash and you never went back in the market and it's laying out there for 10 years? I
Right.
mean, this is a disaster.
It is.
So speaking of things that are lost, I recently met with a client whose husband has dementia. They live in a retirement community, and he has recently become more forgetful. He does things with friends, plays golf, goes out to lunch with her. So she went to tile.com and bought trackers. I don't know how this fits into this article. I must have just thrown this in here somehow. But anyways, this is really good stuff. So she has trackers. She has one on a golf cart, one on his wallet, and one on his phone. So if she can't reach him, she can see where he is on her phone. And if he loses something, it is easy to find.
Yeah, we're not sure how that ended up there.
I don't know. I have
The
no clue.
segue up there says, speaking of things that are lost.
Oh, yeah.
So I guess,
Her husband's lost.
right. So I got to get a tracker on that guy.
Oh my gosh. But you can
Put a
also
tracker on your old 401k
Well, in
account.
Sherry's defense, she had COVID. She was a little foggy.
That's right.
Yeah, I'm still coming out of it, please. Seriously, it's bad. 2 weeks in, and I'm still foggy at 3:00 every afternoon.
Well, tile.com if you have a husband who gets lost a lot and you want to put a tracker on him.
There you go.
All right. 6. Are we ready to move on
Yeah,
to the next
good
one?
enough.
6 tips for consolidating medical debt and avoiding costly interest debt. Healthcare expenses can lead to a range of medical debt from hospital stays, regular doctor's visits, dental procedures, veterinary bills, that one will sneak up on you, and even eye exams. Most medical providers offer payment plans with low or no interest charges, but not everyone is aware of those options. Unfortunately, some providers may actively push you away from these lower cost options and toward the higher interest financial products like medical credit cards. Medical credit cards have become more popular and prevalent in healthcare settings. These cards often have a promotional rate of 0% for several months at the beginning, but then the rates can increase significantly. Studies show that medical credit cards on average have higher interest rates than regular credit
Oh my
cards.
gosh.
That's really high. So be very aware and be very careful.
Yes, be very careful. Usually, after the introductory rate and time, if the balance is not paid in full, the entire balance is charged the new higher rate retroactively. And a lot of people don't understand this when they agree to pay the card. And then the next month, they open their bill and they see the inflated balance.
Right. If you have high interest medical debt already, you are not alone, but have options. We're going to cover 6 of those. 1, qualify for a lower interest consolidation loan. Debt consolidation involves obtaining a new loan with a lower interest rate than what you are currently paying.
At
It's
a
all-
bank or a credit union.
Okay. Credit consolidation loans require a credit check and decent credit. If you don't have a decent credit score, some lenders may still offer you a loan just at a higher rate. You may find better rates at credit unions or financial institutions that you have a history with. However, ensure that any new loan's interest rate is lower than what you're currently paying to achieve savings and pay down the debt more quickly.
So most medical bills do not need to be paid immediately. Staff may be insistent, but you have the right to consider which payment option you will use. If the bill is large and you know you won't be able to pay it in one lump sum, ask for a payment plan.
Right. And before using a credit card or a loan, try working it out with your provider billing department. Ask for an itemized list of charges can help you catch errors and questions that may seem or be incorrect. This is your right, so don't be afraid to ask. For example, if your bill was $3,000 and you immediately open a medical credit card to pay, but later find out you actually, but the actual cost is only $2,000, you're still liable for the original $3,000 with interest added. Instead, work directly with your provider on a payment plan. Many providers are willing to accept small monthly payments, which also help prevent the debt from being sent to collectors.
So I must also add that it is important to understand the consequences of non-payment. Medical debts are no longer supposed to impact your credit score, and unpaid bills under $500 shouldn't appear on your credit report. However, unpaid medical debts can still have consequences, especially if the balance is large. Medical providers may refuse further treatment if you have outstanding bills, or they may send your account to collections. Collection agencies are often very persistent in trying to contact you, and they may even take you to court for payment. In extreme cases, collection agencies could garnish your wages or place liens on your assets. The bottom line, whether you choose a consolidation loan, a debt management program, or work directly with healthcare providers, it's important to understand your options and find the best solution for your situation. You don't want this to ruin your credit, is the bottom line.
Yeah.
That could really mess you up for 7 years.
And at least in all the cases I've ever seen or experienced, the plans that the medical provider works out directly with you are interest free.
Yes.
So why go through a third party interest free when you can go
Right.
directly to them interest free and not have the risk of all the interest catching up to you later?
Well, I
I
think
don't-
what it is a lot of hospitals and medical providers really don't want to carry that and have the administrative burden. They'd rather tell you go get financing for this to a third party.
Well, and if they tell you that, that's fine. But you know what Sherry's point is to ask them first, go to them first before you apply for this stuff. And
Right.
a lot of times they'll say, "Sure. How much can you afford to pay per month?" That's a lot of times what they ask.
The story I hear is they don't tell you that it's an option.
Right.
You have to ask for it as an option.
Right.
So you go and do all this other
Well,
junk.
the other thing to note here is that you do have options. Shop around. Tell them, just ask the office there to give you 2 days to explore your options, because you might be able to get a better deal outside
Somewhere else.
the doctor's office. But you want to get the best interest rate possible, the
Zero
best terms for you at all. Whatever.
for sure.
So anyway,
How does passive income affect Social Security benefits? Passive income can significantly affect Social Security, primarily through its impact on tax liabilities. While passive income, which is things like rental property income, dividends, interest, that's not directly considered when calculating Social Security benefits, but it can influence the taxability of your benefits. If total income, including half of your Social Security benefits and all other incomes, exceeds a certain threshold, a portion of your Social Security benefits may become taxable. However, passive income can also positively supplement retirement income, reducing reliance on Social Security alone. For retirees, effectively managing and timing passive income streams is key to minimizing tax burdens and optimizing overall retirement income. It's crucial to be aware of how different passive income types are taxed and plan accordingly. Consulting with a tax professional is advisable for personalized strategies to integrate passive income with Social Security benefits in a tax-efficient way.
yeah, and different types of passive income can have varying impacts on Social Security benefits. For instance, income from rental properties is typically treated as passive and may not affect Social Security benefits directly. By strategically planning the sources and timing of passive income, retirees can maximize their total retirement benefits. For example, delaying the withdrawal of certain retirement accounts or deferring the sale of assets can minimize the tax impacts on Social Security benefits.
The most common form of passive income that I see with my clients is rental property. The clients I saw recently have amassed 25 properties, and they use the expense of the new properties to help offset the lot of the income. And their son helps them with maintenance full time, and he will inherit these houses. The great thing is, upon his father's death, because the houses are in his name, these houses get a step up in cost basis to the date of death value, so that the son could turn around and sell them all and pay no tax on the gain. So you just have to think, get a CPA, have them look at your situation if you're running into a problem with taxes, and see what can you do differently, or how can you plan ahead for this to go right.
And the step up in cost basis is one of the things that it amazes me that people still don't quite
I
understand.
talk about it every week.
I know, but people still seem shocked when you tell them about it.
They've never heard of it.
And in case y'all don't understand that, it's like there's certain assets that when you inherit them, it's just like the value at the date of the death of the current owner is the new cost basis to the new owner. So
like me and my brothers and sisters inherited my dad's lake house, and it was worth $500,000. So we each got a check for $100,000, and it was tax free.
and tax free at that
And
point.
my oldest brother couldn't get his head around it. He called me. He said, "Don't," because I'm a financial advisor. He goes, "Don't I owe taxes on this?" I said, "No, you got to step up in cost basis to the date of death value." He had never heard of this.
Yeah. And if
It
you
just
didn't
blew
have
my
that,
mind.
and if you didn't have that, your dad paid like $35,000 for that
If
property.
even that,
So
I think his grandmother his mom gifted it to him.
well, it's the point is it would have been almost $500,000 worth of
In
taxes.
gains.
Yeah.
Yes.
Yeah. I had a client recently. I don't remember if I talked about this on the show or not. In the 1950s, I told you guys about it. In the 1950s, he put like $800 into this investment.
Oh yeah.
And currently, the value of that holding is like 150 grand, or it might even be 200 grand. I can't remember the value of it. And we had the conversation, and he's a pretty savvy guy, but he was like, "So I wanna wait until I die for my kids to get this." I said, "Absolutely," because
Right.
the difference is about $200,000 that they would pay taxes on
That's right.
if you give it to them before you die, or you die, you give it to them, they sell it immediately, they pay zero taxes.
That's
So
right.
I can't tell you how many of my clients have wanted to go ahead and gift their house, their land, all this stuff. And I'm like,
Not good.
no, they need to inherit it. You need a will. They need to inherit it
Yep.
to get this step up. It's huge.
You know, we've had friends that literally went ahead and sold property. They didn't give it to their relatives. They went ahead and sold it because it was too much of a hassle, and they realized tremendous capital gains that they had to pay, and then they had to take it out of their IRAs to pay the
Ugh.
taxes. So then they got more taxes they had to pay on top of that. It was just this snowball effect, you
They
know.
didn't think through that, or they didn't know. They
Well,
probably didn't know.
They were more concerned about the hassle of paying the continuing property taxes and things like that. They had the money to continue doing it. They just didn't want the hassle of it.
Okay.
But they could have easily turned it over to maybe one of their kids to do the maintenance on it, and,
Right.
the upkeep, and not that there was any maintenance or upkeep, you know, but it was someone else could have been doing
The hassle part of it.
the hassle part,
Yeah.
right? So anyway, all right, let's talk about. Y'all may have heard this, but credit card numbers are going away. MasterCard announced its intention to phase out printed numbers entirely on these cards by 2030. And in fact, some consumers are already starting to experience this shift in 2025. And you may have mixed feelings about this and perhaps some questions on how this will work. On one hand, everyone who has ever fumbled through the wallet to find a credit card number or over the phone for an over-the-phone transaction is probably celebrating the reported demise of the 16-digit numbers. On the other hand, the way we pay for things may soon be permanently changed, and that uncertainty can be unsettling. Let's dig into that, into what's driving this, and assess what this could mean for you.
I am all in favor of this.
I am too, but I do have questions.
Well, I mean, it may be a short-term hassle, but eventually we learn the new way of doing things.
Right.
And if our information is a lot more protected on account of it, I'm all
for it.
in. All right. So what are numberless credit cards exactly? Numberless credit cards are designed to work without relying on the 16-digit number that appears on the card physically. Instead, your card likely will have no identifying digits at all. This can be done through a combination of popular technologies. You've probably heard of these, but tokenization and biometric authentication. Tokenization is like having your card or giving your card a secret identity for each transaction. Instead of sharing your actual number, your card issuer will generate a one-time use code that is useless to anybody who tries to steal it. That's called a token. This is the type of technology that's currently behind products like Apple Pay. Biometrics can use something unique to you, like your fingerprint or your face, to confirm it's really you making the purchase. Many people already use this type of technology to unlock their cell phones, tablets, computer devices, etc. Combining these two technologies creates security layers that make payments safer than standard number credit cards for both online and in-person transactions.
So why are credit card numbers going away? The short answer: to increase cardholder security for consumers and enhance fraud prevention for card issuers. Thieves have been preying on unsuspecting customers for years by stealing their credit card numbers. Some common ways this happen include snapping a photo of your credit card at a restaurant, skimmers placed at a gas pump, data breaches of online purchase logs. Acquiring the credit card number by any of these means could let a criminal begin a shopping spree with your line of credit.
Yeah, numberless cards can make this much more difficult to pull off. Without a visible number, there really is nothing to steal by the way of any of the above mentioned methods. And even if you lose your card, a criminal can't just jot down those digits and shop online. You may already be conducting business this way and not even realize it. Mobile wallets like Apple Pay, Google Pay already use tokenization, and contactless cards are everywhere. Removing the numbers is just the next step in fraud prevention process that already has been in place.
I should call our cards today and ask if they will convert us over to this.
You should.
That's ridiculous.
Well, it sounds like, just from the sound of this, that it's not prevalent enough yet. They may tell you no. It sounds like we're moving this direction. But How will this change the way you actually use your credit card? The idea of this change may sound scary to those of us comfortable with the way transactions work now in our day-to-day lives, but it's really not as different as it may seem. If you're already tapping your phone or your credit card at the register, not much should change your in-person transactions. You'll still just tap and go, which is already a safer and more secure method than a standard card swipe. Some cards might start asking for a biometric check, like a fingerprint on your phone or the face, like we said a minute ago, but that's an optional layer in today's payment climate.
Online transactions are where the numberless cards may function a bit differently. Instead of typing in your card number, you'll likely use your bank's app or website to generate a token or authorize the payment. That will require some extra steps on the front end, but once you're set up, making the purchase can be quick as a thumbprint confirmation on your device. Online checkouts that accept Apple Pay and Google Pay are already offering you tokenized ways to pay at checkout without providing a credit card number. So, if you've tried that method, you may be well prepared for the numberless credit card world. The downside to this, you're likely going to need a wireless phone or similar device to stay connected with your bank to verify that you're the one who requested the transaction. The upside, it's much less likely that an online predator will commit fraud with your card.
Okay, I've got a question here. I know we've talked a lot about this and kind of nibbled around the edges, and you may not have the answer to this, but what if you're buying something and the vendor doesn't? They have a place for you to put your credit card number in.
How's that going to work?
But yeah, how's that going to work? You have to have an Apple Pay or a Google Pay account.
You have to have a thumbprint or an eye check, or
But they don't have that.
They don't have to
shop elsewhere.
Probably.
Probably.
I mean, those two forms of payment are pretty widely accepted now.
They are. Yeah.
And so maybe if an online store doesn't accept them, you probably should steer clear of that store. Or I think we'll get to a point where if they don't accept those, probably it's better to steer clear because those are pretty prevalent now. But you're right. I mean, I'm sure in the short to midterm, there can be some serious transitioning.
I mean, that's probably one area that I'm still maybe a little behind the power curve. So maybe I should just bite the bullet and get the Apple Pay account.
Yeah, I remember when I first came on board here about 18 months ago, I said, I owed you some money. I said, Randy, what's your Venmo? You were like, I'm not on Venmo.
I don't do any
I said,
of that
okay,
stuff.
what's your PayPal? You said, I'm not on PayPal. I said, how the hell can I pay you back for the money that I owe you? I think I ended up giving you cash.
You did. So I take greenbacks.
Right.
Oh, my gosh.
All right, let's talk about why cell phones have become a leading source of cyber attacks. Smartphones have emerged as a prevalent channel for cyber attacks due to their continuous internet connectivity and vast troves of personal data that they carry. The frequent use for sensitive activities like banking. Unlike computers, they are often less cautious when securing their phones and making them a prime target for hackers. Attackers exploit vulnerabilities through malicious apps, phishing attempts, and unsecured networks. So while not all cyber attacks involve spam calls, they are prevalent sources of this issue.
Here are some of the main reasons why cyber scammers target phones: heavy usage and personal data storage. Smartphones are used for online banking, social media, and managing sensitive data, making them a target for cyber criminals. Frequent app downloads. Many users download apps from third-party sources, often laced with malware, allowing attackers to compromise the phone's security. Lax security measures. Most users rely on simple passwords or screen locks, ignoring more robust security features. Mobile phishing attacks. Phishing scams trick users into clicking on harmful links that compromise their phones. Unsecured Wi-Fi networks. Public Wi-Fi can leave devices vulnerable to attackers who exploit unsecured connections to access data. Mobile malware growth. Apps designed to steal data, monitor activity, or send unauthorized messages from compromised phones.
This growing threat of phone-based attacks emphasizes the need for more robust mobile security practices for individual users and across global networks. It may be an excellent time to talk with your provider about best practices and what you can do to avoid cyber attacks. And on that note, and I mentioned last week, I think on the show, or in the last couple weeks, that we just got our 12-year-old a phone. And that prompted me to look into these kinds of protections, like what we can do to keep him from being where he shouldn't be, or either knowingly or unknowingly, right, for him. And AT&T, that's our provider, they actually have a program in-house that's used to prevent cyber attacks that they either come by phone call, text, or the internet. And it's a free program. It's called Active Armor. So if you have AT&T, I would recommend, whatever you want to call it, that you look into it. Very easy. You get onto your AT&T account, you toggle the service on, and then you have to put the Active Armor app on your phone, and then you decide, like it says, okay, fraud calls. What do you want us to do with them? You can either block them, send them straight to voicemail, or accept them. Calls that are suspicious of being spam, you can block them, send them to voicemail, or accept them. So,
What about text messages? Same thing?
I don't remember texting. I don't remember if it was the same thing on that or not.
I would love to block the texts I get.
I know.
It's just
All of them, right?
trash.
No, I'm just kidding. But AT&T makes it very user-friendly. I would imagine that the other big carriers probably do too, and probably have a free in-house service. So worth looking into for sure.
So, all right. Well, how to recognize and stop common phone scams. The first half of 2024, the most prevalent phone scams in the United States revolved around health insurance. The takeaway, if you get an aggressive call, especially one that offers free testing or medical supplies, demand personal information or money, it might be best to excuse yourself from the call and contact a professional who can speak to the issue. Coming in second were broader insurance scams, which include schemes involving health, auto, life, and home insurance. Takeaway, don't take a caller at face value, whether they say they're from the IRS or the insurance company. Some online advice that I've seen suggests that if you suspect something isn't correct, that you should ask the caller for their phone number so you can call them back. I disagree with this tactic because scammers today can operate call centers, and it will be very, very easy for them to set up an incoming line to impersonate a valid company.
Absolutely.
This is funny. I don't remember if we did, but I thought we mentioned last week this prevalent Peach Pass scam that everybody's getting on their text messages now. And so I'm sure you guys have gotten them, but I had probably 5 in a week text messages saying, if you don't pay your recent Peach Pass bill, you're going to be, I don't remember what the threat was, but it gave me a date of like March 11th or something like that, March 12th. And of course I reported it as junk, never paid any attention to it. And then I got another one after the date that they gave me the first time saying the exact same thing, but it had just moved the date out further. So it's just funny how robotic that stuff is.
Yes.
Here's some additional tips to help you stay stay ahead of phone scams. Don't answer unknown numbers. That's just a rule of thumb for me. Let that go to voicemail. Don't give out personal information, especially not passwords or social security numbers. Hang up on any caller claiming to represent a business or entity and verify by calling the company or agency directly back, which is what Randy was just saying. Register with the National Do Not Call Registry, the DNC list. Use call blocking through your phone provider. That's Active Armor with AT&T, for example. And report scam calls to the Federal Trade Commission or the FTC.
Yes. And, we're down to the last 2.5 minutes, Sherry. Why don't you take this next article and it's really pretty long, but why don't you kind of sum it up about Women's History Month?
So, according to a recent survey, 49% of women consider themselves to be the chief financial officer of their households, up from 41% in 2021. And the fact is that more and more women are finding themselves at the forefront of financial responsibilities. These numbers are even more impressive when you consider that until 1974, a married woman often needed her husband's permission to open a bank account, apply for a credit card, or sign up for a mortgage. Times have changed.
I could not believe that.
Right? However, in today's economic environment, only 64% of women say they feel financially secure, down from 72% in 2021. Despite the challenges, there is no turning back the clock on women's drive toward financial independence and their increasingly important role in their family's fiscal well-being. So let me tell you the advice that I give to women that I see that fall into this category of not sure about their future and all of that. First, they come in for an appointment and they have a list of their income, expenses, debt, and assets. We talk through all of that and figure out what is it that you need to do differently so that you can retire successfully. A lot of people just don't know how to get their head around all of that, and they just make decisions based on what all the people they know in their life are doing instead of doing what's the absolute best thing for them. So if you need a conversation with an advisor, give us a call at 478-922-8100. Make an appointment with me or Jonathan, and let us sit down with you and talk through your current situation, what you can do to increase and optimize your future position of retirement someday, and how you can save more, spend less, and get yourself right-sized so that you can have the confidence of knowing that you are doing everything absolutely right to take care of yourself. And part of this is because a lot of women outlive their husbands, and their husbands pass, and they never managed the money, they never paid the bills, all of that. So give us a call. Let us help you through that.
Thanks for listening to Your Money, produced by Lifespan Wealth Management. As financial advisors, the main thing we do is provide retirement planning advice and manage our clients' investment accounts. If you're looking for an investment advisor, call our office at 478-922-8100 to set up your complimentary consultation. You can learn more about our services by visiting our website at retirerelax.com.
And if you'd like to contribute to the show, you can email me, randy@rfmoney.com, with a question or a topic that you would like for us to cover in a future broadcast. And we look forward to connecting with you next week. Have a great weekend, everyone.
Securities and investment advisory services offered through Osaic Wealth Incorporated, member FINRA SIPC. Osaic Wealth is separately owned, and other entities and or marketing names, products, or services referenced here are independent of Osaic Wealth.